Good afternoon, and welcome back to another Westwood Multi-Asset Monthly video. My name is Ben Chittenden, and I'm a portfolio manager and research analyst on the Westwood team. With these monthly videos, we're going to try to leave you with three key messages. First, how did the asset classes perform this past month? Second, what we're focused on coming up over the next month. And then third, how we're thinking about the environment over the next 12 months. So let's jump in. On our market update slide, we show a 40,000-foot view of returns in the month. You can see that September was very strong across equity markets, interest rates, and credit spreads. To put these numbers into perspective, the S&P 500's return of about 3.7% in September was the best September return in 15 years. Not only that, but the more interesting thing is if you looked at seasonality at the beginning of the month, it wouldn't have been unreasonable to have expected the index to go down in September. This is actually how the month started. There were concerns we would see a sell-off, and we managed to climb that wall of worry all month long. We also saw particular strength in the NASDAQ and growth stocks in general. If we shift over to rates, we see that long rates were significantly lower as the Fed started to officially cut again. The bottom table on the slide shows credit spreads, which were remarkably stable and continued to remain at multi-decade lows. If we start to dig under the hood, we can see the drivers. For the equity markets, we saw strong performance in communication services, tech, and utilities. This was primarily driven by the AI infrastructure trade. In the month of September, we had some very strong earnings from AI-exposed names and a series of multi-year, exceptionally large partnerships that were announced. When we dig into the drivers of fixed income, we can see that higher-rated corporates, and these would be your AAA-rated names, generally outperformed lower-rated corporates. Now, part of this is due to the maturity of the higher-rated corporates. Take a look at the 25-year plus corporate index. I mean, here you see that it outperformed the shorter duration corporates in the month. However, there's also a little bit of a quality rotation that started to take place. And this is just given that spreads are so tight and again at multi-decade lows. So the main takeaway from all of this is that we had a strong month across asset classes, and it was a good time to be in a multi-asset portfolio. Now on to the second point that we want to leave you with. As we get into October, we're really focused on company earnings announcements. We've begun to report, and it's primarily been financials so far. But the message remains one of relative resilience for both the consumer and overall economic growth. We'll continue to listen for the rest of the month, but we want to see some form of either stability or acceleration in earnings estimates. Last but certainly not least, we have our capital markets outlook. As a reminder, we do this CMO every month. It serves as a way to recalibrate our thinking on the outlook for the next 12 months. Now, I'm not going to read every word on this page, but the biggest change here is that the Federal Reserve is finally back to cutting rates again. And we expect Fed funds to migrate towards 3% over the next year or so. We believe that this should provide enough stability to navigate any growth slowdown we may see. We also think that lower rates can serve as a buffer to lower overall market risk. In terms of asset classes, we're neutral on equities. There's no real change here, but we see good earnings growth, but valuations remain stretched. We're negative on credit. Again, no change here. This is just primarily a function of where overall credit spreads are starting from. We're neutral on interest rate risks, and this again is not a change. And we're positive on thematic exposures. Finally, our chart of the month. This month, we're showing long rates in blue versus the Fed funds rate in purple. The idea here is that in the past, long rates typically followed Fed funds rates lower as slower economic growth flowed through the yield curve. This time they're coming down, but just not necessarily as much as one would expect. And as you can see, they're relatively stable in big picture terms. We're also seeing this in conjunction with gold prices moving higher, Bitcoin prices moving higher, and the US dollar moving lower. Now, some of these moves have reverted a bit in October, but if you put all of that together, it does suggest that there remains a risk of higher inflation in the future. It's not to say that the market is always right, but we are paying attention to the signal that it's currently giving. That's all I have for you this month. We're happy to share the slides that I just talked through or add you to the distribution list for the CMO. If you're interested, just reach out. Have a great month, and we'll talk to you soon.